The integrity and objectivity rule is one of the key rules that CPAs need to follow regardless of the type of work they're performing. So you're going to follow this particular ethical rule whether you're engaged in an audit, whether you're doing a client's taxes, bookkeeping, consulting services. And it's really key, not only for the functioning of the CPA firm itself, but the functioning of the financial system, that CPAs are in fact objective when performing audits. Now, there's a couple different cases that could muddy the waters when CPAs are trying to be objective. The first one is conflicts of interest. So this occurs anytime CPA is providing some type of professional service to two different parties, and these two parties' interests are in conflict. So a lot of times we see this in tax where a CPA is representing two clients, maybe a husband and a wife, and they get into a legal dispute, a divorce. So the CPA firm has to think about, well, how are they going to handle this? Now, if they're still representing both the husband and wife and now they have competing interests, are we still able to be objective, to objectively help our clients when we have this conflict of interest arising? And in reality, for most large CPA firms, it's not really an issue when this occurs. They have enough personnel that they can kind of have one party work on the wife's returns, another party work on the husband's return, kind of have them siloed off from one another, that this conflict of interest really wouldn't occur. But if you're dealing with a smaller CPA firm that doesn't have as many resources as a larger one does, a lot of times you're going to have to kind of pick and choose to remain with one of the clients and disengage from the other client. So if you did come across this type of situation, you want to think very carefully how it should be handled, because you don't want to look like the objectivity of your CPA firm has been impaired in some way. Also, a subordination of judgment is another issue where kind of integrity can kind of be put in the spotlight. And this occurs when the CPA is relying on the judgment or work of another party. So basically, one big conflict we see is when somebody working on an audit engagement has a different view of what's going on or how the company they're auditing is handling some type of situation versus other people on the audit team. So maybe I'm working on an audit engagement and I have questions about the allowance for doubtful accounts for the company that I'm auditing. And maybe somebody else on the audit team doesn't have those same concerns. All right, so you want to make sure you document these concerns. You want to have good communications. If I feel like there is an issue with that account, I want to bring it up to others higher above me in the hierarchy. And you want to make sure you document any issues. You want to document the communications had between the members of the CPA firm when they have various views on matters. And you want to document on how the CPA firm actually concluded the issue or problem. So another big focus of our ethical rules is the idea of independence, and this is really the cornerstone of the auditing profession. End users wouldn't be able to rely on our work as auditors if they couldn't be assured that we are in fact independent. So we want to follow the independent guidelines whenever we are performing attestation services. And remember, we talked about this back in Chapter 1, the difference between assurance, auditing, and attestation. So any attest service includes audits, reviews, as well as examinations, agreed upon procedures. So if you're engaged in any of these types of activities, you need to be independent. And not only independent in fact, but also what we call independent in appearance. So independent in fact is a state of mind, basically meaning that we're unbiased and impartial as an accountant, as a CPA, but also, and that's very critical, that's the core of the auditing profession, being independent, but we also want to be independent in appearance. It's not just enough that we are in fact independent. We can't act in a way that leads others to believe we're not independent when we actually are, right? So we have to think about how our behavior reflects upon the firm, how our behavior maybe could potentially lead others to believe we're not independent for one reason or another. And it's interesting when you think about the people working for a CPA firm, how these conflicts of interest can arise and what we need to do to mitigate those situations. So some large CPA firms could have thousands of people working at a particular firm, and obviously not every person at the firm is going to be working on a particular attestation engagement. So what we're talking about with this independence really primarily affects covered members, and that's a term to refer to any person who's in a position to potentially influence the outcome or decisions on an attest engagement. So not every person in a firm necessarily needs to be independent. If we have 1,000 employees working at our CPA firm and we're doing an audit of a client, not everybody in our firm needs to be independent of that audit client. It's really the people working on that engagement or people at a level of authority in the firm that could potentially affect the outcome of that engagement. And we could see here a list of what qualifies somebody to be a covered member in a firm and some of their prohibited activities. So any member of the engagement team, the team that's actually conducting the audit, they are considered covered members, so they're going to have a higher threshold for independence than other folks within the CPA firm. Partners and managers with a consultation, direct supervisors of the engagement partner, all of these individuals maybe have the ability to influence the decision made on the engagement, so they're considered covered members where they have a high threshold for independence. Any accounting firm professional who performs more than 10 hours of non-attest services for the clients. Remember, non-attest services could be things like consulting or tax type work. Partners who are in the same office as the lead partner on the engagement, they are considered covered members. The accounting firm itself as a whole is considered a covered member. So we're going to see when we talk about regulations overseeing investments between covered members and the company they're auditing. All right, so in situations where you're a covered member, you're not allowed to have direct investments in the company you're auditing. Likewise, the entire CPA firm itself is not allowed to have those investments. Now, other folks who are not covered members who work for the CPA firm can in fact still have investments in this client if they're not in any of these roles we're talking about here. A couple other individuals that would fall under the category of covered members, people who are evaluating partners' performances and compensation, accounting firm professionals who consult with the attest team regarding technical or different types of industry knowledge, and individuals who participate in quality control activities for the firm. So if you find yourself falling in any of these categories, you're going to be considered a covered member. And there's certain activities that are prohibited for covered members. We have them listed here. I want to jump ahead to the next slide. It kind of gives us a better, more detailed breakdown of some of these requirements specific to investments. Now, a covered member can own a mutual fund. And remember, a mutual fund is just an investment that owns a number of different stocks. So we could have a mutual fund that owns shares in the attest client, even as a covered member, as long as that investment in the mutual fund is not material to the covered member. All right, so that's kind of an exception to the rules. If that investment is material to the covered member, all right, then independence is impaired. In that case, you want to remove yourself, all right, from the position where you're overseeing any work on the audit, or you'd want to get rid of those investments so you can keep your independence intact. Covered members aren't allowed to engage in joint investments with attest clients, and this makes sense. You don't want to have them have mutual financial interests that could lead to kind of issues where your objectivity could potentially be violated, or at least the appearance of objectivity certainly could come into question. Also, a covered member cannot be a trustee of a trust or an executor of an estate that invests in the attest clients. The covered member should not be in a management position to exercise authority over a direct investment in the attest client. So again, we're trying to, kind of build these silos where, the CPA who's doing the audit, all right, or an attest function, all right, they are not going to be kind of auditing their own work. And also the accounting firm as a whole is not allowed to take on any of these activities of covered members. So again, you can have people working at a large accounting firm that have investments in an audit client of that firm. That's fine as long as they're, all right, not considered covered members. But the CPA firm as a whole, the firm cannot own investments in a client that they are auditing. That would be a gross violation of independence. In addition to folks that are considered covered members, those folks working at the CPA firm, there could be a situation where independence could be violated if there's close relatives working for a company that we are auditing. So this next slide here shows who, in fact, could be considered covered members from immediate family. So a spousal equivalent, any dependents, parents, non-dependent children or stepchildren, brothers, sisters, stepbrothers, stepsisters. These all can meet the definition of a covered family member. All right, so let's say, for instance, that you're working on an audit engagement and your spouse has a key role in the company that you're auditing. All right, that's going to lead to a potential conflict of interest. That's not going to be allowed. So we could see if any of these individuals, any of these family members, all right, perform any of these functions for a company that we're auditing, all right, that's going to lead to a breach of independence, and we're going to have to rectify the situation somehow. Oftentimes, the person within the CPA firm is going to remove themselves from the engagement if any of their family members, all right, are engaged in these prohibited activities. So, for instance, a spouse or any of these individuals, for that matter, can't be employed in a key position of an attest client. So we can't have, a parent or a spouse having influence over the financial statements. They can't prepare or supervise others who prepare the financial statements or material accounting records. They may not hold a key position with an attest client, and they can't hold a material financial interest in an audit client or have significant influence over an attest client. So notice this final blurb here is a little bit different between audit clients and just plain old attest clients, like a review, let's say, of a company's financial statement. So if you have a situation where you have any relatives in this category performing any of these functions for a company, that's going to raise ethical issues. We need to document that. We need to figure out a way to go about removing that threat. Now, another issue that is problematic is when a CPA is offered employment by a client. So you see this happen from time to time, especially when you have a relationship, years going on between a CPA firm and a client. Maybe the client is really impressed with the work that a member of the CPA firm has done in the past when auditing their financial statements. So they want to hire that person. They want to bring them on, maybe to work as their controller or treasurer or some other position within the company. Well, if you're working on an audit of a company at the same time you're potentially interviewing with that company or they're thinking of hiring you, this could be a huge threat to independence. So when a situation like this happens, when a client offers a job to a member of the audit team, or if there's some type of negotiations or there's interviewing, we first off need to make sure that we report this. If this is happening to you, if you're being offered the job, you need to report this to somebody in your CPA firm, and you're going to need to remove yourself from the engagement until the employment offer is rejected or until the employment offer is no longer being sought. So really important. That could get folks in a lot of trouble if you're auditing, a company's work while you're considering taking a position with a company. All right, that can kind of lead to a conflict of interest and some ethical issues.